Welcome everybody to the next video of this FX program. We're going to jump straight into it. In this lesson, what you've covered so far, essentially in this program, are basics leading up to tying the strategy together. We're not at that stage yet. There's still a few things that you need to learn before we tie the whole thing together, and I can show you some real examples. But in this video, I'm going to explain the difference between counter trend and continuation entries. And then that way, when we do tie in the strategy together, it's a lot easier for you to understand. But these two things you have to know before you can obviously start executing the strategy alone. And yeah, so it's just a really important topic for you to understand in general as well, even if you use another strategy. And it's very basic. So look, a counter trend entry is essentially when the entry is executed in the opposite direction of the overall market. So just say GBP USD is bearish. It's been bearish for the last week or 2 weeks, 3 months, etc. Say higher time frames from like the weekly, daily, 4 hour, 1 hour, etc. is all bearish. You're taking a buy. That is a counter trend entry. And essentially in those positions and scenarios, you're taking advantage of retracements and other influences, which we're going to get into. And I'm going to explain and show you on the charts both of these examples, and we can break it down from there. Now, a continuation entry is essentially a trade that's obviously the opposite to a counter trend. It's in line with overall market structure. So overall, that asset is bearish. We're taking sells in line with that asset. So you're trading with market structure. You're trading in line with what is most dominant, which is sellers. And yeah, a lot of traders start to create little strategies around liquidity grabs and manipulation and so on and so on. And they like to really, like their whole strategy relies around trading the opposite to long-term market structure. For me personally, you don't know. I like to trade what I see and what confluences are in front of me. If market structure overall on the higher time frames is bearish, obviously the ideal scenario is to be taking sells. You're not a hero. You're not some, huge institution that has hundreds of millions of dollars, if not billions of dollars, to influence the market. No, you're a small retail trader, and that is the complete truth. You can't manipulate price, so there's no point trying to do that. Whereas counter trend and continuation entries, there's good to have both options once you have a good understanding of how price moves and also fundamentals. If you don't have a good understanding of macroeconomics, one, you're not going to understand the overall picture and where price is going long term, and then also short-term price movements, because there could be upcoming catalysts that you have forecasts as a bullish effect for that asset when long-term market structure for that asset is bearish, if that makes sense. And you're taking advantage of a small counter trend entry. But counter trend trades all should be very short. And because they're aggressive, they're very aggressive entries, you should be very aggressive with your risk management as well. Counter trends are higher risk, and you should be on the ball. You should be very quick, and you should be monitoring price action throughout the whole trade. It's not set and forget. That's completely different. That's more like continuation entries. But counter trend, you have to manage your risk really well, and you're trading opposite to overall market structure and the trend overall. So when you're taking profit and you're moving your stop loss and you're managing risk, it should be very quick, and there shouldn't be any greed involved whatsoever. So, and I think that's a lot of the time when people fail their funded accounts, it's because they're taking counter trend entries and they're getting greed. They're getting really greedy with it, and they hold those positions for too long, and it ends up going against them and they lose. So if you are taking a counter trend entry, make sure you're very aggressive with your risk management. And that's a saying that I've always had. If you're aggressive with your entry, you have to be aggressive with your risk as well. And it's as simple as that. So look, that pretty much sums it up. I'm going to jump straight onto the charts now and show you guys this in depth. Alrighty, so we're on GBP USD on the weekly time frame. We're going to do a top-down analysis for this, and I'm just going to show you a basic continuation entry and a basic counter trend entry as well, just so you guys sort of get that understanding nailed into your head. So on the weekly time frame, let's start doing our immediate viewpoints. Obviously, I like to, if you haven't been trading for very long, I like to step my way back to a higher time frame like the monthly and just have a look at overall market structure. Clearly for this asset, we've been bearish for quite some time, but we don't need to heavily focus on that just yet. And especially if you're trading short term, the monthly, the high time frames is just an overall picture and understanding of that asset. What I can see already is this part here where we've had 2 breaks of structures to the downside, because obviously we were stepping our way up. We had this big bullish range here. From here, seen wick, we had a lower high, lower low, broke structure here. And what we've done is we've broken internal structure here, but we failed to break above this high. This wick has retested this area. We failed to break above it. And then we've broken minor internal structure to the downside again. So for me, this is a little bit of a bit of a orange flag, yellow flag, if you say, mainly because there's not like absolute certainty in terms of high time frame direction. There is not absolute certainty. What I've already identified now is a range. So from this high to this low, we are struggling to break outside of these range and get clear direction because we've broken internal structure here, bearish, indicating that we're going lower within this range. And then we broke structure again, but we failed to break above this high. If this had broken structure to the upside, even though we've had that bearish break of structure internally to the downside, I would be more bullish. But because we failed to do that, then I'm not 100% certain. And what we can go off right now is just the bearish immediate viewpoint, which is from this high to this low. So technically, yes, this would be a bearish weekly immediate viewpoint from this high to this low, but I would be very wary that there is a bit of indecision on the higher time frames. And obviously, considering what's going on in the world right now with the war and the Strait of Hormuz, I can't say the word, don't believe me, not being open and how that's affecting supply chains across the world, there's a lot of uncertainty. Even on, obviously, the dollar is the most affected pair. There's a lot of uncertainty on the dollar as well, which you can just literally, and this is why it's so important to have the DXY. I'm getting slightly sidetracked here, but this is why it's so important to look at the DXY, because you can just confirm that. Okay, I've identified a range. It implicates that this asset is quite uncertain on the higher time frames. DXY, also the weekly time frame. Look at this big range right here. And I would actually just draw it from here to about there. We haven't broken above, we haven't broken below. It's just internal slop. We've had breaks to the downside, break to the upside here, break to the downside again, respected this low, broke structure to the upside. Now we've created a higher low. Is it going to continue going higher? Until you get a strong break below like that or like this, you don't know, all right? So uncertainty, that's just one thing that we've ironed out on the weekly time frame. And as you're learning, if you're a beginner, write these down. So as you're working your way down the higher time frames at the top here, write down weekly. It's bearish, but uncertain. Just make sure you just keep notes of it. I used to write even on my screen weekly, and then I would write like this, and then I'd do bearish, and then if I actually daily bearish or whatever, and I'd keep that on my screen just to, as I was learning. Let's step our way down to the daily. So we've identified bearish, weekly, immediate viewpoint. Daily, already what I can see is bullish. Just from this internal structure, we start our way from the top of this range. This is all bearish, creating lower highs and lower lows. Then we created a high highs. We broke structure here. So daily, even though it's messy, is bullish, indicating that we are retracing higher within this range. But again, because the weekly is uncertain, we don't 100% know that, and we just have to go off what price is telling us right now. 4 hour is also bullish. Bang. And then the 1 hour is also bullish. Very sloppy range here. But let's just say, all right, because we've got the weekly, that's technically bearish. Daily is bullish. 4 hour, 1 hour is bullish. But let's say the weekly's bullish, right? So we've got the weekly is bullish, daily is bullish, 4 hours bullish, 1 hour is bullish. Taking a continuation entry is simply scaling down to the lower time frames, and because it's a continuation entry, the risk to reward is usually higher. But I wouldn't be wanting to take a buy all the way up here because it's a continuation entry. So I've identified I want to be buying ideally, but we've scaled down to the lower time frames and we see this huge rally to the upside. I don't want to be buying at the top here, especially now that I can see prices starting to slow down. That doesn't give a strong confluence for me to be buying because the risk of price retracing is quite high. And this is where I use tools like VWAP, which I will be getting into in future videos, to identify whether or not it's a good time to take a retracement or a mean reversion trade, which is essentially a counter trend trade. So ideally, the strongest position is buys, but instead of waiting for, price to come all the way down to areas like this, right? Just say it's areas like this. You've marked your levels. Let's say hypothetically, there's an area here, whatever your strategy is. We've marked levels. We're waiting for a retracement. You're setting your alerts like this for price to retrace. Instead of waiting for price to do so, we can take advantage of that retracement. Because ideally, we're going to be waiting for it anyway. Let's take advantage of that and complete a counter trend trade. I hope this is starting to make more sense for you guys. We've identified, ideally we want to be taking buys, but the lower time frames, we've got this really big rally to the upside here. We don't want to be buying because it's, I guess, overextended, as you could say, but essentially the chances of price retracing is quite high, and I don't really want to risk a buy position up the top here. So what we can do is wait for internal structure, bearish structure, to break to the downside at the top here and look for a sell to the next level. So what essentially I'd be doing, go down to the 15-minute time frame here, and this is looking much better. So we've created a little bit of consolidation here. This is what it usually looks like at the top of a rally or the bottom of a trough. We got a bit of a battle here. Price is struggling to break higher. And then we have a break of structure to the downside, lower high, bang. That's essentially what you're looking for, is a structure break like this. And then taking an entry at the top here. But obviously this is not London session or New York session, so volume is quite low. And because these entries are quite aggressive, you need to be aggressive with your entries as well, because it's not always going to give you an opportunity to have a beautiful retracement into a nice level on the lower time frames to take a short position. It's not always going to do that. So sometimes you have to be very aggressive. And what I mean by that is waiting for one structure break to the downside after you've seen consolidation. So look, in this scenario, if we can go down to the 5-minute, we might actually have a level around here. So there is one here, but let's like pretend this was higher. Ideally, for me, this is a little bit too risky, but you could take a short position here because we've seen internal structure break. This high failed to break above. We had a break of structure to the downside, a level here. And see, I wouldn't have my stop loss here. That's where I'd want my stop loss at that high. So this is just not a very good position at all, because I wouldn't want my stop loss there. It's just, there's no reason for it to be there. There's no significant level. It's a pretty risky trade in my opinion. But look, even if we got into an entry here and this is where our stop loss was, my target would be, my final target would be just the next level. Whatever the next level is around here. If we scroll back to the hourly time frame, this is well under 50%. So like if you just measure this out, 50% mark is here, right? And this isn't some rule or strategy or anything like this, but all I'm saying is a short aggressive position should not be more or at 50% of that entire range. And simply because if you go and back test and collect your data, you'll see that price will actually continue going higher, especially because it's following long-term market structure. All of the higher timeframes are bullish. And this is where having a good understanding of fundamentals is, because if you understand why price is bullish, you understand the amount of fuel behind that market structure as well, that price movement. So you would understand how significant trading in line with bullish market structure is, which would also give you a very good indication on how aggressive you want to be with your short position. If your macro fundamental analysis is very strong bullish wise, then yeah, you want to be very aggressive with your short position and get out of it as soon as you can, essentially. But if I was in this position, essentially I'd set my target, but it doesn't necessarily mean I would just set and forget. I would be monitoring this entire trade until price essentially breaks structure to the upside. So here we can see price continued pushing lower, had a break of structure to the downside. That's great. But then price retraced and we had a bullish break of structure to the upside. For me, I'd be out of that position. I'd be out. And ideally, this sort of price action happens a lot lower, like this. And then this is where I would be like, right, I am out of this trade from there. And that's how aggressive you need to be with counter trend trades, because price is essentially going against you. You're going against market structure. So you need to be very aggressive with your risk management, your entries, and monitoring that like an absolute hawk. Too many traders, they get greedy with counter trend trades because they think that they can read the future, when you just can't. You just need to trade what you actually see and go based off that. Continuation entries are different. You've got a macro fundamental analysis behind it. You've got high time frame market structure behind it. You've got momentum behind it. So for example, if price in this scenario, let's pretend all of the high time frames are bullish, price retraced, just say we got that counter trend entry, price did hit our take profit, which is great. Price ends up hitting this area, we get a little reaction off it, maybe some consolidation, then a bullish break to the upside. Then I would be looking to take a buy position in this area. putting my stop loss beneath the previous significant key level. And this is just a pretty like basic example. And if we scroll back, that's the 4-hour range. So that would be like, and it's also the hourly. So I would put this as my first target, but because all of the higher time frames are bullish, you can actually have your final target as the daily and the weekly high, because all of the timeframes are indicating, they're telling you that price is wanting to push higher. It's wanting to target those highs. And that is how you trade profitably as a trader. You're trading what you see and what you know and what the data in front of you is actually telling you. Now, I wouldn't set and forget either, but this would be ideally my final target, and I would have partials at these highs as well. So this is the high of the 4-hour immediate viewpoint and the hourly. So if, let's say, the hourly immediate viewpoint was different, say it was a bit lower, that would be my first target. So because we executed on the lower time frames, like 15-minute, 5-minute, you wouldn't target the 15-minute, but you would have partials at the 1-hour high, 4-hour high, daily high, weekly high, etc. And that's how you take advantage of a very big position like that, and you can hold it for much longer, and monitor your trade and manage your risk well. But I hope that makes sense, guys. It's a very, I think, useful thing to understand, and it may not make too much sense for you right now, especially because you haven't even tied in the whole strategy yet. But feel free to come back to this video eventually once I've released the rest of the program and rewatch it as many times as you can. I will have a quiz right at the end of the program. I'm going to have a quiz full of questions to test your knowledge as well. So everything will start to sink into your head. But no matter what strategy you use, this sort of concept, counter trend and continuation entries, is super important. Understanding market structure, understanding fundamentals, what's actually driving price, and then being able to capitalize on mean reversion trades. So we've identified price is super extended here. Ideally we want to be taking buys in line with overall market structure, but price is most likely going to retrace from here, and we're going to take advantage of that. So if it does, let's be ready for it. Sometimes price doesn't, and you actually see just some consolidation here and price pushes up higher. But either way, you're going to be ready for price action to do its thing. So I hope that all makes sense. I hope you all enjoyed this lesson. As always, if you have any questions, make sure to tell me in the comment section below. And make sure to join the free Discord community. The link is in the description. So if you are interested in joining community, you can ask as many questions as you want in there. I'm in there. You can ask me, and there's plenty of others that are happy to help where they can as well. So that's all for today's video, guys. I hope you all enjoyed, and I will see you on the next one. Thanks, guys.